what we're going to talk about today really is just the swing trading markets. If you look at the markets and you think you have a sure thing, you have to always be open to all opportunities. And the current market environment is such that we have essentially non-free markets. Markets are being centrally steered to some extent, so it's even trickier. My point is you have to always be able to see both sides, and that goes with most trading strategies, certainly the ones that are sort of a few days to a few weeks in terms of time frames. Having said that, let's talk about the agenda today. I'm going to quickly start off with a word on swing trading, just generally what is it, why do I do it, why do subscribers enjoy the swing trading aspect as opposed to, say, a day trading or a more longer-term type of investment strategy. When we talk about attributes of the market, of a market correction, which I think is extremely important to understand, markets that go down have an entirely different character to them than markets that just go up. And I think we're at a pretty good point in terms of timing this year to talk about that. We have essentially a market that is 180 degrees different than what it was up until May 22nd. And then we'll talk about three strategies. First one, shorting the broader market, how. Second one, shorting the most overbought sectors, and how. And thirdly, we're talking about an option strategy. I found that certain markets tend to be very kind to specific option strategies, and actually there's a message popping up here. And the down tape, from a swing trading perspective, actually tends quite well to one of the option strategies that I'm going to go through today as well. A quick important note, I always mention this one during my webinars. The definition of swing trading here, as far as I define it, is very much my own, although I don't think I'm very far off the mark. But just keep in mind there are different definitions of swing trading. To mine, same thing goes with the strategies. You know, there are not just my strategies. There are tons of other strategies out there. So when I talk about a swing trading strategy, these are just the ones I use. So let's talk about why swing trading. And swing trading it's an interesting time frame to operate in because it pretty much allows you to trade with fairly little stress and at the same time also no boredom. A lot of folks get started in trading. Some people even start getting right into the highly leveraged type of markets such as futures and foreign exchange, and there tend to be a little bit more in the day trading time frames, which can be unbelievably volatile, extremely unforgiving, and extremely nerve-wracking. The swing trading time frame is right in the middle of that. It's longer than the longer time frame than that, and hence you can do this with a part-time job. You can do this if you want to play golf on the side. If you're retired, even if you have a full-time job, you can still do this. So it's a very good sweet spot in terms of timing for people who don't want to sit in front of their computer all day long. The reason I do swing trading is because I've found that by day trading or the longer term stuff, I tend to look at it a little bit more as a gamble. That's my personal. I'll give you my personal reason why I went with swing trading eventually. Trading at the end of the day is a business. It's not entertainment, and a lot of people that start off with trading, or even if you've done it for a long time, there's always the proverbial carrot dangling in front of day traders to trade when they shouldn't. If you do a swing trading strategy, which has a time frame of about 2 days to 4 weeks, the margin of error for doing a trade a little bit too early or a little bit late is a lot higher. So, in other words, if you're trading futures or the S&P 500 SPY ETF intraday, you probably have to be on the mark a lot more exact than if you were to do swing trading. So the time frame is 2 days to multiple weeks, 2 days because it's not day trading, and 4 weeks because sort of after a month or so the trade really should be over. If it hasn't done anything yet, you stop it. If it's gone in your direction, you take some profits. If it's gone against you, you stop out as well. So I use stops both in terms of time and price. We'll talk about that in a little bit later as well. It's a sweet spot, so it's too long for day traders. By definition, day trading is, of course, within the day. Yet it's too short for institutional investors. So institutional investors, if I talk to my colleagues that run pension funds, or my friends, I should say, that run pension funds and other sort of slow-moving type of vehicles like insurance funds and so on, their time frames are a lot longer. And if you're operating within time frame of 2 days to 4 weeks, you have really very little trades that are not very crowded. I think that's the next point. A plethora of setups every month. In other words, just because it's not crowded doesn't mean there aren't trades setting up. There are trades setting up every week, multiple times. So that is another great thing. There's enough trades to deal with, even if you miss one. And the last but not least, I think what's extremely beneficial to swing trading is that you really have clear, defined stops and profit targets in the strategies that I use. My strategies are based on very clear support or resistance zones, based on certain things like candlesticks and things like that, and confluence zones that you can read about in the ebook that Kenny talked about. And in other words, if you have a stock or an ETF or whatever it is that goes beyond a certain very visual spot on the chart, you automatically stop out. There's really no emotions involved. That's the rule. It's very simple. Whereas if you have a little bit of a longer time frame, people tend to be somewhat more lenient with their stops. And the same thing holds for day trading. I know plenty of people who started day trading who just it's literally not within them to be able to stick to their stops, and that's a psychological issue with trading. So swing trading from a psychological point of view is much easier to do than the shorter and long-term ones, in my humble opinion of trading markets for 14 years. Just quickly, a word on a swing. What is a swing? People, if this is the first time you're listening to me, what actually is a swing? A swing is a lot of it is really defined in hindsight, right? Which makes this business at the margin a little bit tricky if you think about it this way. But as you see how I look at markets, trading markets from the short side, you'll see that there's really not much you don't have to deal with hindsight. In fact, if your strategy involves dealing with the hindsight, then you have a problem. So swings basically are moves in one direction that usually don't end on one single day. They usually take a few days at least to turn around and form a bottom or a top before then resuming in another direction. And in terms of time frames, swings can be as long as years, but they can be as short as say 2 weeks, right? So in my strategies, I always try to take about either the beginning, the first say 5 to 10% out of a swing, and by the first 5 to 10%, I don't mean literally the first 5 to 10%, but I mean like say after a couple percent or so, you then try to take a little bit, or you try to take some out of the middle. Each swing usually has consolidation zones within the swing that allow you to continue to trade in the direction of the swing. But again, we'll talk about this in just a second as we look at trading a down market. So let's talk about the attributes of a market correction. And as I said before, markets that go down have an entirely different personality than markets that go up. And I think that is pretty obvious if you look at what has happened so far this year. Let me quickly just show you the chart of the S&P 500 so far this year. Make this a little bit larger. And let's look at the S&P. So if you look at the S&P, for the most part this year was very simple: retracements, rallies, tight patterns, and breakouts. Okay, retracements, rallies, consolidation phases, and breakouts. Those four things are really defining a strong uptrend as we had so far this year. You can see this very clearly if we draw a simple trend line on the S&P 500 daily chart here. And you'll see that mostly it's been a boring tape all year until we got to May 22nd, when we had the Bernanke top, when Fed Chief Ben Bernanke was giving us the latest testimony, the latest not the FOMC meeting, but the one before in May. At that point, the character of the market changed within a matter of hours. In fact, minutes. Things got extremely choppy on an intraday basis, and I'll show you this with the so-called average true range in just a moment. And of course, in hindsight, and again, I don't like to operate in hindsight, but as a reference point, you can see we've now broken below that 2012 November uptrend that was intact until Thursday morning. So let's go back quickly to the presentation. And let's talk about it. So the a market correction most of the time follows an increase in intraday volatility, nervousness on part of the investors. It's a precursor to market sell-off. Doesn't have to be, but most of the time when the market gets more nervous, you'll see a pullback of at least 5 to maybe 10 or 15%. And I think again at the moment we're having a pretty good example of just that. So let's look at an average true range chart. I made one just before as Dave was talking, and if you see the chart, at the top we have the S&P 500, at the bottom we have something called the average true range. Now the definition of average true range, you can look it up on Wikipedia or something. It's no brain surgery. Essentially, to make it very simple, it tells you how wide is the average daily trading range. Okay, and if you look at what we've seen here in the S&P 500 over the past month or so, as the Bernanke top came in on May 22nd, the average true daily trading range on the S&P 500 has gone from a little bit above 10 points a day to currently just about 23 points a day. So it's basically doubled, okay, to sort of round up or down. That is probably the most important thing to understand. People who focus, who look at the market from a swing trading perspective, inevitably have to have a little bit of an idea of what's happening intraday, and they have to understand the broader picture. So if you're day trading, if you're swing trading, that's really the point, and that's why it's such a sweet spot, in my opinion, as well. You have to be aware of the other time frames. If you're a longer-term trader or an investor, I think more or less you don't really care what the intraday movements are, which in this case, if you didn't pay attention to it, you maybe wouldn't have seen this coming, at least if this is the only thing you would have focused on, which of course in most cases hopefully it isn't. But an average true range and a spike in intraday realized volatility. Okay, this is different from implied volatility, which is what the options are pricing in. This is realized volatility. Actual realized volatility started spiking right at the Bernanke top in May. Very, very important to understand. We now have a much more nervous market. We haven't seen a market this nervous since, actually, it hasn't been a 23 since at some point here in 2011. So that's pretty significant. Also, if you want to talk about a breakout, we actually had a breakout above the 2-year peak in this, and it's, again, fairly important to understand. Go back to the presentation quickly and talk about what do I look for in the market from a swing trading perspective when I consider the market has run too far or is ready for a more meaningful correction. I like to watch the bond market as someone who comes from the fixed income world. If you talk about sell side Wall Street, the business, you either have bond guys or equity guys. I from a trade was a fixed income guy, but of course over the years as I did trading at various shops and hedge funds, more focused more and more on the equity side because I found out that actually with equities you can trade a lot of the bond market as well. So watch the bond market. I'm going to show you a chart right now that gives us clues that the market, the equity market, was really due for a correction. And this, from a swing trading perspective, something I really like to focus on. Let's look at the S&P 500 chart versus the what is in this case the yield of the 10-year Treasury note. I'm sorry, there's a distinction there. On one hand, we have in blue the S&P 500, and in red we have the yield. Okay, not to be mistaken with price, the yield of the 10-year bond. 10-year bond in terms of yield put in a recent low, also actually a little bit early in early May, so gave us an even earlier signal than the Bernanke top did, and yields started spiking from something like 1.5, 1.6% all the way up to about 2.5%. That is, folks, that's a 90 basis point spike in yields. I don't think, I have to go back and check the facts, I don't think the bond market has sold off this hard in about 20 plus years in a matter of 1 week, especially this week. I think this year we went from 2.5 or 2.1% to 2.5%. 30, 40 basis points in the bond market is tremendous. Very, very important to understand this dynamic in the bond market as it pertains to swing trading, because it gives us more conviction to lean against levels, and I think that's the next thing on the agenda here. We're going to talk about. So do focus in the bond market. Don't focus too much on momentum oscillators, but note the broader divergences. Okay, what does that mean? I like to focus as it comes to swing trading when I lay out the what I call the market structure, not to be confused with the technical definition of that, but my understanding or my definition of market structure is what's driving the market. Okay, in my experience, using momentum oscillators in the classic way to determine if a market is toppy or not, it doesn't hold very well. I think momentum oscillators work better intraday or on a shorter-term basis. What I do like to look for is divergences. What do I mean by that? Divergences work this way. If you have the stock market, in this case the S&P 500, continuing to go higher, you want to see somewhere near the peak, or what in hindsight will have been the peak, a negative divergence of the oscillators. In other words, oscillators are making lower highs versus price still making higher highs. If I were to show you now a chart of the RSI oscillator or MACDs or things like that, I think almost all of them, at least on a weekly basis, gave us very clear signals of that. Couple that with what the bond market did and what the commodity markets have done for months now, and you saw that equities were the only things that were still holding up in this market, and they have now finally caved. Okay, and again, just I can't stress enough how important it is to look at cross-asset things to understand the market structure. Let's go and quickly go back to the presentation. I do like to study weekly and monthly charts and other asset classes. Like I just said, I don't just look at charts with daily compartments. I like to look at the weekly and monthly charts. In other words, you have charts with a bar or whatever your kind of chart you're using have weekly compartments or monthly more visual appeal. So if I were to show you the chart here of the S&P 500, this is a daily chart. Let's do a weekly chart and note how the weekly bar here on that week of May 22nd, the Bernanke top, was actually a lot more bearish, especially if you continue to consider the continuation selling. You couldn't have seen this in a daily chart. You needed to look at a weekly chart, week 1, week 2. So you have a bearish week followed by continuation selling. We hadn't seen that in a long, long time in the market, and that's extremely important. Just like last week, we finally broke on a weekly closing basis, broke below an important weekly candle that we had just a couple of weeks ago. So again, I like to focus on daily charts, but also weekly and monthly charts to give us a better picture, a better idea of what the broader picture is. And I think that's it for the attributes. Let's see what else I had. More on a specific stock front or within stocks, I really like to focus on the financials. The financials, whether it's intraday or on a monthly basis, give us a clue what the broad market will do. Financials are extremely important to the market. The market will have a very difficult time rising unless the financials continue to go higher. Much like the market has a hard time going down, the financials don't participate. A lot of times they are a leading indicator, and of course the financials being interest rate sensitive companies, especially the banks and insurance companies, you will see signs from both the bond market and the financials that more or less should is the keyword overlap. If they don't overlap and the bond market's telling you something that the financials are not, you might have something to do with financials, because you should always trust the bond market unless it's being rigged, which we are hopefully more and more come to an end of that part. So maybe let me say this. From a bond market perspective, I think the bond market is finally becoming a better indicator again. Now, since 2009, we've had the market being steered by the central banks. I think we're finally at a point where if they ease off the pedal a little bit, the market will again become a more important market to watch, which I certainly will welcome. Okay, further attributes of market reaction. They say no one makes money in a bear market. And for the most extent, it's actually true. If I talk to colleagues of mine that work on the sell side or on the buy side at private banks and the fund managers and things like that, most folks don't make money in bear markets because they're most of the time, and I would say 95% of the time, they're long biased. They either don't have the mandate to go short, they're scared, they don't know how to do it, or God forbid, they're ignorant to do so. And I'm not advocating that one should focus strictly on shorting the market, but if the market goes down for 3 to 6 months, why not participate in that, at least to some extent? So in bear markets, very few people actually make money. But I don't think it has to be that way. I think you can actually make a lot of money in bear markets, and especially from a swing trading perspective, I always like to really press my positions and make a good part of the yearly performance in down markets, or at least markets that are more volatile, which most of the time that's unanimous with a down market. Most can't handle the volatility. That's another point. People freak out when they wake up in the morning. Futures are up or down, 0.5%, 1%, 1.5%. They can't do it, and I'm not so much blaming them. I'm just stating some facts here. It doesn't have to be this way. Like I said, swing traders, or at least me in my strategies, I absolutely embrace volatility. That does not mean that I'm always every morning hoping for the world to fall apart. Quite the contrary. I just see when there's imbalances in the market, people get nervous. Human beings are emotional creatures, and the times to really make money from a swing trading perspective, and when I say making money is make above average returns, is to really be able to pounce on the insecurity in the market, on people's emotions, right? If you watched Wall Street number 2, when Gordon Gekko said that when ugly becomes ugly, the ugly get going, he was really essentially, at least from a trading point of view, that's what he's getting at. And I think it's all about being able to not freak out during market volatility. What you also have in down tape is sharp and volatile counterbalances, and I think that's really what freaks people out. So let's talk about the that sort of phenomenon in the market, because people will go short and put a stop that's way too tight on in a down market. And like as I said before, we've now have an average true range of 23 points in the S&P 500. That is big. Okay, I'm not saying this can't come in and we can maybe go down to 15 handles a day over the next couple of weeks, but 23 points at the moment corresponds to just about 1.5% of movement. So almost any given day now we have 1.5% moves from peak to trough on the intraday basis. That freaks people out. The problem is people then go in, and given their time frame that they might not be used to reading the market correctly, or at least not reading the levels correctly, they then short the market at the wrong time or buy it at the wrong time, right? So one little fact, known fact, is that after you have two 90% down days, as we had on Wednesday and Thursday, you tend to get a bounce between the next 1 and 5 days. We had that coming into Friday morning. Now we had a marginal bounce of 30 basis points. But again, I had a lot of people calling me Friday morning say, listen, I'm going short. And I'm saying, listen, yes, we can fall further, and I think over time we will fall further. But the sharp, volatile counter-trend movements is really what freaks people out. I suspect that at the moment we could get a quick 1 to 2 to 3% rebound in the S&P 500. That's really going to freak people out, and that's really what makes people fail in down markets. They don't know when to go short, when to press their positions, because they're used to trading these nice and steady uptrends that are more or less, for lack of a better term, brainless things to do. You simply buy the pullbacks to a simple moving average or a simple trend line, right? That's why a lot of people made money until May 22nd, and a lot of people are a lot of funds that I know are already up only a couple percent a year so far this year. A few of them are already down a few percent. Let's go back to the presentation quickly. So when you have an average true range or an average daily range of about 23 points in the S&P 500, what that means to me is I need to reduce trading size. A, because it allows me to stay in the trade a little bit longer, and B, just because of the nature of the fact that we have wider trading ranges, I don't need to have in equal position to if average trading range is 10 points to make the same amount of money. Okay, very, very simple analogy. Increase in trading frequency. Another thing I like to do when the market gets tough like this or the market gets volatile, I like to increase my trading frequency. It doesn't mean I have to flip in and out of the market 100 times a day. I don't. But from a trading perspective, I reduce my trading time frames from an average of what might be an average of 2 weeks down to maybe an average of 3-4 days or so. That's just because the market is so volatile. I want to be able to stay in the trade and be able to read the market and reevaluate every single day. In a down tape like this, the market can swing back up on the back of any slightest positive news, and that's another thing that people forget. If you trade the same side, if you trade the same time frames, you will get chopped up and you will lose confidence. So reduce size, increase trading frequency, but don't overtrade. Right? There's a very very important distinction there. This I already talked about. 2 consecutive 9% down days lead to a 1 to 5 day bounce. A very simple thing to note, but I think unbelievably important. It will allow you to time the market a little better from a swing trading perspective. So let's talk about what I like to short when the market is going down. As opposed to shorting individual stocks, I prefer, on balance, to short the broader market. Why? Because, as I said, from a swing trading point of view, I like to get above average returns during these more volatile environments and really pounce on people's emotions. So what I don't want to do, I don't want to risk not making money. Okay, In other words, if I short stock XYZ in the financial sector, there's a good chance it'll go down if the market drops 2%, but it's not a sure thing. Okay, if you are short whatever the bank is you might want to short, and the market goes down 2%, but your stock for some reason bounced on some better expected news or a new CEO, whatever, right? You're going to be very, very, at least me, I am very frustrated not to make money. So the probability of a trader making money in a down tape by focusing on sticking to indices and sector indices and ETFs, I think are superior, at least from a swing trading perspective. The other thing is that technicals work very well on the way down. They work well on the way up, but in my point of view, technical levels and retracements and some of the technical indicators I use work better in a down tape. At least somewhat better. The other thing I like to do, I like to define reference and target stop levels constantly. So if we're now looking at the XLF, as I have talked about this one a few times now, might as well bring up the chart. This is the financials ETF, right, of the financial sector, the S&P 500. If we're talking about reference levels in this ETF, I like to keep them simple, but I like to have them on my charts every single day. Okay. First of all, I like to operate with a simple 50-day moving average. In this case, in the XLF, now moving averages don't. Every stock, every ETF, every index has a different personality. Some moving averages work better for other indices, for some indices than others, or even for us on an individual stock basis. But if we're looking at the XLF right now, there are very simple reference levels you want to map out and trade around in a down tape. If we just focus on some simple trend lines, we'll draw one off the May 2012 bottom, we'll draw one off the November 2012 bottom, and sure enough, we have a first reference point of support right here at the uptrend from November 2012. The financials have not yet broken that. However, from a market correction point of view, this is exactly where I would want to see the first bounce. Okay. At the same time, we have lateral support dating back to the peak here in April before the breakout in April, as well as roughly around the 100-day and 50-day moving average. Again, this is just what works on this, but on average, I find that the financial, the 50, 100, and 200-day work quite well on the S&P 500 itself and its indices, its subsectors, I should say. So again, map out individual levels to trade against, have a plan, and understand that the market is more volatile. Give a lot of room for the market to increase your margin of error, trade smaller size, and shorten your time horizon. At least that's what I like to do. Let's go back to the presentation quickly. Talked about why technicals work great. From a longer-term point of view, I like to also use the 200-day or the 140-day moving average. The 140-day, just like the 150, work pretty well. Work almost as well as the 200-day, depending on the index. If you want to note this down, just maybe play with it. The 140, from a swing trading point of view, a lot of times will tell us if the market is still in a bullish mode or flipping to a bearish mode. Just one little nugget of information there, if you want to note that down. Correlation is high, right? So this goes back to the point I said earlier, short the market, not individual stocks. At least that's my mantra. It doesn't mean I won't short some individual stocks. I'm short a few individual stocks right now that are trading in tight patterns. But more or less correlation is high. So if you're shorting the financial sector, correlation is very high. In other words, the chances that JP Morgan will go down on any given day when the broader market's down is just as high as say Goldman Sachs will go down. And that's exactly my point. If given this high probability and correlation is high, you then pick the one stock that on that given day or week or whatever your time frame might be is not going down, you're going to be very, very frustrated. Quickly on correctly drawing multiple trend lines. I think I just pretty much laid that out. This may be a topic for another day, but I like to draw my trend lines very simple. I connect the bottom dots of any pullback, and you can see on the XLF right now, the first reference point we've gotten to, which coincided with the 50-day a little bit, between the 50 and 100-day. The next one will come in rallying off the June 2012 lows. Let's see what the next thing is here. Levered ETFs, that's another thing. I mean, folks always ask me about levered ETFs because they don't like to trade options, and I can understand that. I think Dave made a good point about that. There's a lot less stuff to worry about, margins and all that stuff, and interest rates. At the end of the day, they work to, I just think when you use levered ETF, the 2 and 3 time, or the inverses, you have to just make sure that you trade them, you use them as trading vehicles as opposed to investments. You will lose money over the long term if you trade them for investments. Simple ETFs here, the SUY, IWM, and QQQ that I like to focus on because they give us the most clear signals most of the time. Even also from a candlestick point of view, if you want to look at the S&P 500 signal it gave us on Friday. With a daily close, we came to a 100-day moving average, its blue line, which coincided with lateral support somewhat in a range, and it gave us a bullish hammer candle. Doesn't mean the market can't fall further on Monday or Tuesday, but it does mean that the odds of a bounce here, at least a 1 to 2% bounce, are better than they were coming into say Friday, into say Thursday morning. And what else do we have here? The other thing you can focus on, and I like to focus on when it comes to trading at downtime, is I like to short steep sectors, or in some cases also very steep stocks. It's very simple, but it's effective. If you look at just from a slope point of view, I like to focus on shorting the steepest slopes. Or, like I said, stocks within a certain sector that is extremely steep. The slope that's extremely steep. Again, correlation during these corrections increases. Thus, the chance of any given sector going down along with the broad market is quite high. I'll give you an example right now quickly as well. If you look at the index chart here of the S&P 500, you'll note that the utility sector started selling off all the way back in May, gave us a clear signal, but some of the steepest sectors, and I can show you this via the sector performance, you'll note that right now still the highest the sector in the S&P 500 that's had the sharpest rally still year-to-date remains the XLV, which is the healthcare sector, followed by the financials and the transports. From my point of view, for my money, those are the three sectors I'm focusing on for trading on the short side. Okay, that's again from a trading point of view. That's not there's no tactical asset allocation or all that stuff in here, but that's what I like to focus on. They've had the sharpest rallies so far this year. So they are likely, from a trading point of view, to have the sharpest corrections. Doesn't mean they can't outperform again very quickly, but they're likely to come down the sharpest. From a pure slope perspective, it's just gravity that's at work here. Gravity tends to work in markets as well as it does in life. Some of the sectors, like I said, I mean, I like to focus on the financials, the technology, the transports, and here too, I like to focus on weeklies, charts, daily charts, divergences between oscillators, and very tight patterns. And maybe a quick word on tight patterns, and I think we're almost slowly coming to a close of the presentation. Let me show you when I'm talking about tight patterns. let me show you what I mean, and I'm again going to use an index chart here. Let's use the financials since we've used them the whole time. But you can use tide patterns to swing trade in down markets as well as in up markets. If we look at tide patterns that we had in the S&P 500, say here in February, we had a very nice consolidation phase that ultimately led to a breakout. We had it again here. And it works on the downside as well. Okay, if we look at the down tape, let's go back to maybe 2011. You'll see that tide patterns to focus on also work in down tapes. This here is the downswing of 2011, of course, very nasty in August, and we did have very clear, defined levels, somewhat of a tide pattern here to focus on, reference levels and a little bit here before as well. We had some bull flags and things like that. So tide patterns is another thing I think it's very important to focus on when it comes to swing trading. Downtrends, it works just as well as it does in uptrends. And last but not least, just a quick word on option strategy I personally like to use. Either you can buy index puts or another option strategy that might suit you. The problem with index puts is you're going to have to be a little bit more correct in terms of timing. But if you saw the divergences that I just saw, I put up before from the bond market, from the financials, from the utilities, from the commodity market, you could have made the case of buying puts as early to mid-May. What I prefer to do, though, is I like to sell far out of the money calls or call spreads. If you are familiar with options trading, I prefer to be a net seller of options, which means right off the bat you have about a 75% chance of making money. I'll show you this in a chart in just a second. But I like to capture 5 to 10% of the slide, of that first slide in the stock. You can use cold stocks. You can use some of the more volatile ones out there. I like to sell options 2 months out, 10% out of the money. Personally, I'm not a big fan of covered calls. It has the same payoff diagram as short puts. People will disagree with the covered call strategy not being great. That's just my take. But selling calls or call spreads in sharply spiking stocks, and let me give you an example right now, is, in my opinion, an interesting trade that I also like to focus on from time to time. So if you were to look at, say, the chart of Boeing right now, Boeing has a tendency to rise up through I think the Paris air show, which of course we had, I think, just last week or the week before. An extremely steep slope. If you look at this chart in the context of a few years, it doesn't take a genius to realize that this is extremely steep. From a price or percentage point of view, the stock rallied from March through the peaks just a few days ago, rallied at 35%. For a stock in the Dow 30 with a huge market cap, that's very, very steep. At this point, of course, you have to find a reversal point to sell into the stock, and we did. We had a big, nasty outside reversal day on the 19th of June, which would allow us to sell out of the money calls. I'm hoping in this case 5 to 10% out of the money. That would have made us would have been a very high probability trade to make money. It works even better if you have a stock that's a little higher priced. So if you look at something like in higher price in terms of absolute dollar amounts, I think the good example was Netflix in 2011. Yeah, exactly. So Netflix, notorious, trend-following stock, it was in 2011. Extremely steep slope. Ultimately, the stock at the time we did this trade allowed us to sell calls and call spreads. I think something like 20 or 30% out of the money. for huge, huge premiums. The stock only needed to move lower by like a couple percent. Actually, it didn't need to move lower at all if you would have held it by expiration, by just going down a couple percent, we already had made a lot of money. So that's one strategy on the options front that I like to use, swing trading. And I think, if I'm not totally mistaken, I think that's all I had to say. Let me just quickly go back into the presentation. That's it. I'm open for Q&A. If there's any questions, maybe some individual tickers, I'll hand it over to Kenny.
Well, Serge, thank you very much. That was awesome, and I think that like I said earlier, it's nice to kind of the way that we've had this set up today. It kind of just builds on what Dave kind of set in place, and then now getting into more of the active and the technical stuff. We have a couple questions here that I definitely want to get you run by you and have you answer, and then we're gonna move right into the final presentation of the day. So let's start off with something a little more broad, and then we'll go into some of the specifics. First question is, Serge, what would you say? And this is from Jamie. So Jamie, let me know if we need to build on something. But what would you say how much you rely on fundamentals versus technicals within your strategies?
Yeah, sure. If it's the Jamie I'm thinking of, I'm glad you're listening in. Basically, from a swing trader point of view, I don't really need to focus on fundamentals when it comes to individual stocks too much. Why? Well, because it's just the way I operate, right? What I do focus on, though, is what I just talked about when it comes to looking at or measuring the market structure, right? So measuring the market structure, when we just talked about looking at cross assets, looking at measuring what's really moving the market, and people will make an argument for anything for either philosophy. Personally, I think if you can get the market structure correct, if you can understand what's moving the market, I personally think that's an easier trade to do than trying to pick apart the financial statements of a company. So for that simple reason, I don't focus too much on fundamentals. Of course, if earnings come out, I will always have a look at those in some of the stocks that I focus on.
Great. I think that definitely gives a better understanding of kind of what kind of factors go into a lot of your decision making. And you had mentioned very early on in your presentation, and I personally cannot recall, so I apologize, but there's a question here that said you had mentioned that you don't see a downturn in the market as being the best time to trade. You seem the up, or to start buying, I guess, stock, or to trade. And someone made a comment that they think that when the market's kind of going down, it's the best time to start capturing and kind of I guess I'm assuming get things low. Do you is that was first off, I guess, and I apologize for making it maybe confusing just because the question was worded a little tricky, but do you is that correct that you stay away, or you're more, I guess, looking for your profits on an uptrending market, or do you find it on both sides pretty well?
Yeah, I mean, that's sort of the essence of my strategy. I like to, if you were to divide the year into, 3 or 4 different market environments, which is something we usually get, I like to distribute it more in terms of outperformance or making money on. Of course, this is an alpha strategy. In other words, an absolute return strategy. I don't really care what the S&P 500 does. So, comparing the performance of a swing trading strategy like I have to the S&P 500 is a little bit useless. Actually, it's very useless. I like to really make more relative performance in a downtrending market, or I should say in a more volatile market, right? A lot of times that's the same thing, not always. If we have a simple trending bull market, there's plenty of money to be made, but I think from a relative point of view, I like to press my bets more in down markets.
Okay, great. And I think that that probably clarifies it. And a lot of times it depends, like you said, it's just kind of what the basis of, your strategy is, and also, just preference. It's you have to feel comfortable with what you're doing, and what kind of trading you're doing, and so some people feel more comfortable, I guess, in different types of market environments to make
Mm-hmm.
different actions. Um, Kind of building on some of or getting into more specifics. Um, do you use any indicators? The only ones that Steve had noticed during the presentation were mostly moving averages.
Yeah, if you look at I would urge anyone to download the ebook, the that Kenny talked about before. I
Yep.
focus on a lot heavy emphasis on candlesticks, on moving averages, on simple trend lines, on Fibonacci. Fibonacci is a crucial part of my trading strategies. Fibonacci retracements, volume to a lesser extent, and certainly some oscillators. I prefer to use the stochastics, but the way I use them, I could just as well use MACDs. It doesn't make a huge amount of difference for the way I use them, which one exactly I use, because more or less, and again, if you're a quant listening to this, you will totally disagree, but from my point of view, more or less, the oscillators measure similar things.
Okay, great. So the questions are coming in, and we are kind of pushing for time here because I know Raymond is waiting to kind of jump into his presentation. But I do want to get through a couple quick more questions here before we wrap up and move on. Um, where do you think the bottom for SPX is coming in the next 2 or so months?
Personally, I think the S&P definitely has room down to 1500, maybe 1530. Again, the beauty of swing trading is that I can change my mind every single day. But I think, uh, given the broader divergence we see in the market, I wouldn't be surprised to see a 10 to 15% market correction, which we tend to get any given year. So that's just what I see right now. And again, I think the market structure is built such that equities have been the only safe haven yet that people were willing to go into. They too will have to correct at some point, and I think we're at the point now where that's going to happen. It's not going to be a straight line. That's more or less what I said before. That's the tricky thing about this. But if you can define levels and keep your size a little smaller and trade more frequently, then this is this will be a great time to make a lot of money over the next couple months or so.
Sounds good. What kind of software are you using for your cross asset analysis?
I for the more cross stuff, I use Bloomberg, which I know is not very retail friendly because it's expensive. But I also, from a charting point of view, just for stocks and ETFs and things, I use a tool called eSignal.
All right, great. And um, what for IRAs that can't short, there's ETFs out there that are bearish. Do you have any suggestions on which ones, or I guess which ones would you use if you were in that position?
Yeah, I mean, personally, I'm not a huge fan of using the inverse ones. Um, just use the big ones. What is it like? Let me see here, which is just I think important is that you use ones that have a lot of volume. So you can use whatever. Just yeah, I don't want to give specific tickers on this, but if you use the ones that have at least a couple million shares of volume every day, you'll be fine. I think that's really it's a volume here is extremely important, as it is with stocks, right?
Right. Makes complete sense. Okay, so this is the last question we're going to do here, and then any other ones that we didn't get to or that come in, we'll get Serge to answer them, and then we'll put them in the email that will go out with the whole day's recordings and some other questions for the other presenters. What was the ATR for reducing your size?
At what level?
Yeah.
To me, it wasn't so much a specific level as it was the acceleration at which it increased. But we went from an ATR of like 12 to 16 very, very quickly, and that to me was a sign, you know. And again, it wasn't just you know, a decision I made on a single factor. You know, a multi-factor model here in this case, for lack of a better term, definitely was taking cues from the bond market and the other things I laid out. So it was more the acceleration, almost like the gamma of the ATR, if you mean the acceleration as opposed to the speed, right? And yeah, so that's how I'd answer that.
All right. And while I kind of get things set up here for Raymond, I got one last question. We'll sneak in, and then we'll kind of end on that, and you know end on some last words here. But with the current 5% drop, do you foresee another 5 to 10% before it runs, its course?
Yeah, that's more or less the same question before, and it's a fair
Right.
question and an important question. But yeah, I mean, I think again, it's not going to come in a straight line. Um, like I said before, some indices like the financials and the financial are very important. Like I said, they haven't really broken the major downtrend yet, but most other things have. So I would expect, unless we get I don't know, some sort of miraculous hand uh, from the central banks again, and I don't know, I'm not quite sure what they could do to keep this from falling, but I would expect another 5 to 10%. Again, it's not going to come in a straight line. It's going to be choppy, most likely. And here I'm saying this now. We'll just wake up Monday morning with a 2% down futures. But on average, that's the probability game I like to play, right? I think what's different from this correction so far compared to the rest of the year is that we have growth in terms of from an economic point of view starting to probably the economic numbers getting probably as good as they can get in the immediate term, in the medium term, I should say, and that's probably been already reflected now in some of the other things I talked about, including bond markets and commodities and things like that.
Gotcha.
So
Yeah. Right.
yeah,
Okay. So Serge, I want to thank you again for taking part in this, and I know you caught a little cold, and really appreciate you still coming around. I know a lot of the people here were here to see your presentation, and it definitely was a great amount of information and resource. And I want to remind everyone that Serge does have his new ebook that he just got done writing, and has it out there. It's called The Essence of Swing Trading.